Hi there, welcome to Kneppy Invest. Almost exactly 10 years ago, August 2012, I took a position in JB Hi-Fi. Even though I was warned at the time, this was the most shorted stock on the ASX. And in fact, I'll show you a story from Sydney Morning Herald later in this video exactly on that. But every single time I went into a JB Hi-Fi store back then, it was full of people browsing or buying stuff. And to be honest with you, times have not changed. Every single time I go into a JB Hi-Fi store now, it is full of people, again, browsing or buying stuff. So one of the reasons why this company was the most shortest stock on the ASX 10 years ago was the fear of the online presence. Amazon was going to completely destroy this company. Well, it's been 10 years and that has not happened. Now, that does not mean it's not going to happen in the next 10 years, but I think JB Hi-Fi has grown significantly in the past 10 years, and the threat of online, the threat of Amazon is probably lower now than it was back in 2012. And do you know the other thing that hasn't changed in regards to JB Hi-Fi? The PE ratio. When I bought JB Hi-Fi 10 years ago, the PE ratio was 8. And right now, it has gone back to 8, which means this is the cheapest JB Hi-Fi has been in 10 years. Now, before we move on to looking at financial year 22 results for JB Hi-Fi, which is the whole motivation for me doing today's video, I'm just going to look at the chart. Now, this is the weekly chart for JB Hi-Fi going back to 2011, so sort of an 11-year chart for the company. And between 2011 and 2012, you can see share price dropped a fair bit. In fact, the share price of this company dropped from $20 all the way down to a low of $8 because there was a short attack on this company. Not only on this company, but other retail companies on the ASX. In fact, retail companies dominated the 10 most heavily shorted stocks on the local bourse, with JB Hi-Fi being the most shorted of those. In fact, 21.2% of shares in JB Hi-Fi in August of 2012 were shorted. Unfortunately for those shorters, they would have lost a lot of money, because that was the share price low for this company. And one of the reasons they were shorting is because of that threat of online destroying all these retail companies on the ASX. And that was a mistake, because the share price of JB Hi-Fi has kept on going up. This has been a phenomenal retail success on the ASX. So just looking at this chart, the share price has increased 5-fold over the past 10 years. Unfortunately for me, I sold out when the share price doubled. I thought I was really smart, selling out when the share price got to about $18 or $19. And one of the biggest mistakes you can make as a long-term investor is by selling out too soon and not taking advantage of compounding. Not only compounding in the share price, but also compounding when it comes to dividends. A company like JB Hi-Fi will increase their dividends at a consistent rate over time. Now to the financial year 22 results for JB Hi-Fi, and this company has been increasing their revenue year on year over the past 10 years, probably even longer than that, but I'm just going to be focusing on the past 10 years. And revenue is up to $9.2 billion. Yes, $9.2 billion, with profits of $545 million and operating cash flow of $627 million. Now, as you would understand, this being a retail company, the margins are quite low, but JB Hi-Fi have been increasing their margins over the past 10 years. So even though the revenue is increasing at a certain rate, we'll say 10% per year, the profits have actually been increasing at a greater rate than that because of improving margins. The earnings per share right now is at $4.77. So take a look at the share price, $39.47. So you don't have to be a mathematician to know that the PE ratio is less than 10. In fact, it is 8 right now. And that leads me to believe that a valuation of $4.4 billion for JB Hi-Fi might be an attractive valuation. It might be quite low for this company unless some bad things happen in the future. And I think the market is a little bit wary, not only in regards to JB Hi-Fi, but other retail companies out there in regards to the expected growth or the future growth in this company over the next few years. Now let's have a look at the revenue growth for JB Hi-Fi over the past 10 years. And when you look at this, this is exactly what I want to see for any company. Revenue growing at a consistent rate year on year. In fact, every single year, the revenue for JB Hi-Fi has been greater than the previous year. You notice a bit of a jump in revenue from 2016 to 17. Revenue grew from 3.9 billion to 5.6 billion. That's in regards to an acquisition the company made of the Good Guys. But even if you take that into account, revenue has grown for this company. In fact, since 2013, over the past 10 years, revenue has grown at a compound annual growth rate of 11.3%. Over the past 5 years, after they made the acquisition of the Good Guys, revenue has grown at 10% per year, and in the past 3 years, at 9.8% per year. You also notice there isn't any significant jump in regards to COVID-19. So even though this company's revenue have been affected by COVID-19, and you're able to see that in the quarter-on-quarter breakdown for financial year 22 in the next few slides, you don't see any massive spike in revenue because of COVID-19. So this company just keeps on succeeding in growing their revenue year after year, and there's no reason why they can't keep doing that in the next few years, the next 5 years, even the next 10 years. In the next 3 slides, I'm just going to break down, the company broke this down for us in their presentation, financial year 22 presentation, and they broke down the individual divisions' quarterly growth through the year, through financial year 22, just to show us how this company was affected by COVID-19 in the first quarter, and then how revenue grew in quarters 3 and quarter 4. So this company did not have a good first half, but had a really good second half. The other thing to take into account is revenue growth in financial year 22 was only 4%, so significantly lower than the revenue growth we've seen over the past 10 years. But if you look at the last or the second half of financial year 22, revenue grew at more than 10% for all of the whole company, including all 3 divisions. So this is JB Hi-Fi Australia. The other 2 divisions are JB Hi-Fi New Zealand and the Good Guys. So JB Hi-Fi Australia have performed significantly well in the second half, with revenue growth 11.9% and 11.6%, and overall for financial year 22, revenue grew at 4%. In the first quarter, revenue actually went backwards by 7.5%. Onto JB Hi-Fi New Zealand, didn't quite perform as well as Australia division, and that's one of the main reasons for that is really sluggish growth, in fact backwards growth in the first half. In fact, the first 2 quarters we saw negative growth of 6.4% and 3.4%, but then we did see revenue accelerate in the second half, 4.8% in the third quarter and 7.7% in the fourth quarter. And overall, revenue for JB Hi-Fi New Zealand grew at 0.3% for the full financial year 22. And a similar story can be said for the Good Guys here, with revenue accelerating through the year, and revenue grew at 7.8% during the fourth quarter of financial year 22, and overall revenue grew at 2.7%. So if you take a look at the 3 divisions, by far the best performing division is JB Hi-Fi Australia, which is understandable. I will go into JB Hi-Fi way more often than I'll go into the Good Guys. In fact, I can't remember the last time I went into a Good Guys store, and one of the reasons for that is the nearest Good Guys store to me is a long way away. Now to the financial statements for the company. And in this slide, I'm going to look at the cash flow statement. In the next slide, I'm going to look at the reconciliation of the cash flow statement, which was found in the notes. So the main thing I'm looking for here is cash flow from operations. And then I'm looking for any interesting tidbits in the cash flow from investing activities, and there's none really there, or the cash flows from financing activities, and there's a couple of interesting things there. But overall, the company was operating cash flow positive by 627 million, which was a good improvement from last year, which was 558.7 million. And the big thing you'll notice in the cash flows from financing activities is this company did off-market share buyback. $250 million they spent, which makes sense, particularly if the company thinks JB Hi-Fi is undervalued. They also paid $310 million in dividends to shareholders, and $177.6 million in payment of lease liabilities, which is really important for retail companies, because more than likely retail companies are going to rent the stores they are selling their products. And that is definitely true with JB Hi-Fi. They also borrowed $60 million. I'm not sure why they borrowed $60 million, but the cash on hand actually fell from 263 million to 125.6 million. And one of the reasons why the cash on hand fell was because of that fairly significant off-market share buyback. Now onto the reconciliation of net cash inflow from operating activities to profit, found either in note 5B or 4B. The reason I like to look at this is I just want to know how JB Hi-Fi went from a profit of 545 million to a net cash inflow from operating activities of 627.4 million. And there are three main reasons. Well, there's quite a few reasons here. The first reason is because of depreciation, amortization, $215 million for this year. Not much change from financial year 21. A significant increase in inventories, almost $200 million increase in inventories from last year. And last year, there was a $200 million increase in inventories as well. The other thing here is there was an increase in current payables of 54 million. Last year, there was a decrease of 46.5 million. So whenever you see a number here, not in brackets, in the change in operating assets and liabilities, if it's in brackets, that's a cash outflow. If it's not in brackets, it's a cash inflow. So that the increase in current payables is actually a cash inflow. And that's one of the reasons why this company finished in cash from operating activities of 627.4 million. So the main thing I want to know here is this inventory build-up. Why is JB Hi-Fi increasing their inventory over the past 2 years? And in factual fact, they mentioned this in the presentation. So this is what they mentioned. This is what they said. Inventory at June finished at 1.14 billion, up 21%. As inventory availability continued to improve from the low closing inventory positions in financial year 21 and financial year 20 that have resulted from COVID-19 related supply shortages. As compared to financial year 2019, inventory was up 28% versus sales growth of 30.1% over the same period. Now to the historical inventory levels for JB Hi-Fi. The reason I wanted to look at this is just to see if this increase in inventories over the past 2 years is abnormal for the company. If it's something to be concerned with, if they're building too much inventories and they're going to have a problem in the future, like they're going to have to sell products at significant discounts. And when I look at this put everything to ease with me because the significant build-up in inventories over the past 2 years is not significant. It's just going back to the long-term trend. And they sort of mentioned that with the fact that the growth in inventories over the past 3 years has mirrored the growth in sales. So inventories have increased since 2013 from 426 million to 1.1 billion. You see a significant increase in receipt of inventory in 2017. That's when they bought the good guys, and then a significant decrease in inventories in 2020. And then it's gone back to the long-term trends over the past 2 years. So this particular graph put all my concerns at ease when it comes to inventory levels for this company. One of the things that intrigues me about JB Hi-Fi is their moat or competitive advantage. And in fact, in their presentation, they sort of try to explain what their competitive advantage is. They talked about scale, multi-channel capability, people and culture, and low-cost operating model. Now, scale, multi-channel capability, people and culture, not really sure that is a competitive advantage or moat this company has. But low-cost operating model is definitely one of the competitive advantage JB Hi-Fi has over their competitors. And in fact, every single time you walk into a JB Hi-Fi, you'll notice how effectively and how efficiently the whole store is laid out. Really simple and really, you'd think, and I don't know this at all, but you'd think they don't have to spend a lot of money for the particular layout these JB Hi-Fi stores have. So I do think low-cost operating model is one of the advantages JB Hi-Fi has over their competitors. Another thing that the company did provide in their financial year 22 results is financial year 23 trading update. Looking at the sales growth for July, and everything is moving quite well for the company apart from New Zealand. New Zealand, in fact, has gone backwards in terms of sales growth. But JB Hi-Fi Australia, sales growth at 9.7% for July 2022. Good Guys at 7.8%, while New Zealand is backwards or negative 0.9%. Not sure why New Zealand or JB Hi-Fi New Zealand is struggling at this point in time. Now to the valuation of JB Hi-Fi, and in my opinion, it's really important to know the valuation. Just understanding whether a company is high quality, low quality is not enough. You got to look at the valuation. Is the company overvalued undervalued, or fair value, because you don't want to buy a company that has a PE ratio of 1 million. If it grows at, say, 20% per year, you will be overpaying for that company, and expected future returns for that company with a PE ratio of 1 million might be negative, even if it is a high quality company. So for JB Hi-Fi, the PE ratio is around 8.8 right now. Might be a little bit lower than that, because when I figured or calculated that valuation total, that PE ratio, the share price was a little bit higher. Price to sales ratio is 0.48. Price to operating cash flow, fairly low at 7.37. Now, it's okay just to look at these numbers in isolation. So what does 8.8 mean in historical levels for this company? Is it a high PE ratio, or is it a low PE ratio? So that's the next thing I'm going to look at in regards to JB Hi-Fi, is comparing that PE ratio to the historical norms for this company. So this is the PE ratio for JB Hi-Fi going back to 2012. The reason I go back that far is because the last time we saw the PE ratio of this company reach 8 was back in 2012, when that was a short attack on this company. You can see from 2012 up to 2013, the PE ratio of JB Hi-Fi actually increased from 8 all the way to 1920. So there was a significant turnaround in the sentiment of this company during 2013. That's also the time we saw the share price of this company more than double. So there was some multiple expansion and some financial expansion that led to a significant increase in the share price of this company. And over the past few years, we have seen the PE ratio of this company fall from the 20 range all the way down to 8.8, which is right now. Even during the COVID-19 financial panic, the PE ratio of JB Hi-Fi never fell below 10. So right now, I think there could be some really good value for JB Hi-Fi at a PE ratio less than 10. But there are concerns about the future of this company in terms of growth levels, not in terms of whether this company is going to survive or not, but just the future growth of JB Hi-Fi. I think there's a lot of people, the market is concerned about possible recession, putting a bit of a lid on the sales growth of JB Hi-Fi moving forward. Now, the other thing I'd probably mention is one of the reasons why the profits of this company have grown at a greater rate than the revenue is because of increasing margins. Now, there's only so much a company can increase their margins. So there is a possible scenario moving forward where this company has low single-digit revenue growth and decreasing margins. And in that scenario, we actually see profits of this company go backwards. That's a definite scenario in the future. I'll probably say a low possibility future, but it's a definite thing I am looking for moving forward, or looking at moving forward with this company. Now to the daily chart for JB Hi-Fi, and when you look at this chart over the past, it's almost 2 years here, going back to the start of 2021, nothing at all exciting in regards to momentum, sentiment, or anything like this. So if you were a momentum, sentiment sort of investor, JB Hi-Fi is the sort of company you would not be owning right now. So the only reason I'm interested in JB Hi-Fi is the valuation. And I think there is possible good value when it comes to this company right now at any price less than about, we'll say about $44. And right now the share price is less than $40. That's all I have for this video, looking at JB Hi-Fi, focusing on their financial year 22 results. The main reason I'd take a position in JB Hi-Fi is around their valuations right now. Not because the chart, not because the share price is in an uptrend or there's positive sentiment behind this company. It's all around the valuation. And when I focus on valuation, the big question is the company high quality or low quality? So I just want to buy high quality companies when it comes to valuation. When it becomes a low quality company, I'm more interested in the sentiment and the trend in the share price. And right now, I do think there is a possibility, and you could argue with me about this, that JB Hi-Fi is pretty good value at a share price less than $40. If you have any questions, any concerns, any thoughts, just leave in the comment section of this video. Otherwise, I'm not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.